Hi guys, Ron Parks here and welcome back to my channel. Everyone's asking, why is the stock market up? Well, economists consider the stock market a leading indicator of the economy, meaning it often signals where the real economy is headed. But it's sometimes faulty. The stock market crash of 2020 began on Monday, March 9th, with the Dow plunging 2,200 points, or around 7.8%. It was followed by two more record-setting point drops on March 12th, as the Dow sank another 2,300 points, or another 10%, and then March 16th, when it fell again by almost 3,000 points, an almost 12% drop. The stock market crash included the three worst point drops in U.S. history. The drop was caused by global fears about the spread of the coronavirus, oil price declines, the anticipation of layoffs, and the possibility of a 2020 recession. There were only two other dates in U.S. history which had more unsettling one-day percentage falls. They were Black Monday on October 9th, 1987, with a 22% drop, and December 12th back in 1914, with a 23% drop. Although this dramatic 2020 market crash is still fresh in everyone's mind, I think it's important to take a look at really what happened and why. That will allow us to anticipate what may happen next with the economy and the stock market. The United States has been grappling with a global pandemic, an economic meltdown, massive protests, and unprecedented unemployment. And yet, until recently, the stock market basically shrugged it all off. Between March 23rd and today, the market surged over 40%, wiping away the drop it had seen at the start of the pandemic. And last week we saw a change when apparently the market rediscovered that there's a dangerous pandemic still going on. Public health experts have been warning for months now about the dangers of reopening without a solid plan for testing and tracing. But they're just uptight, right? Oh, this might be a good time now. By the way, it would really be great if you can smash the like button for the YouTube logarithm and subscribe. It will really help. No one has hard evidence to explain why there seems to be a disconnect between the stock market and the broader economy right now. The best we can do is look at actions of the masses and the psychology of millions of buyers and sellers, who each are telling themselves their own stories about why they're making the trades they're making. There has been an explosion of day traders in the market whose experience and expertise are quite limited. That's why it's important to think about investing and the psychology around investing. Nobel Prize-winning economist Robert Shiller's new book, Narrative Economics, says we've seen this pulling out your hair disconnect between the stock market and the real economy before. Despite the mass unemployment and turmoil of the Great Depression, he says that we had a huge boom in the stock market from 1933 to 1937. And some of the takeaways from his book tell an interesting story and can give us some indicators on where we might be going. Here are some of Shiller's ideas. The perfect storm of stupid. That's a theory basically that Americans are super bored, they're at home, sports are canceled, the kids are screaming, the casinos are closed, and around 800,000 additional people have decided to plop down money on the biggest roulette table of them all. He notes that means tons of new people are playing the markets at a time when things are so uncertain that hundreds of companies canceled their 2020 earnings guidance. There's no model that can predict what's about to happen to the economy or the market. And Bloomberg columnist Matt Levine calls it the boredom markets hypothesis. And Business Insider columnist Lynette Lopez calls it the perfect storm of stupid. Shiller didn't shoot down this theory. He thinks it's just speculation. He says, but it seems like people want to do something to stimulate the economy. And corporate America is immune from pain. The stock market represents only a fraction of the economy represented by publicly traded companies. Restaurants and small businesses and independent contractors have been hammered, but the vast majority of them are not listed on the stock market exchange. Facebook, Amazon, Apple, Netflix, Google, they represent 20% of the value of the S&P 500, and they've been making out pretty well during the pandemic. And corporate America has been getting handouts from the Federal Reserve, which is buying trillions of dollars of corporate bonds, pumping trillions of dollars into the economy for special unemployment payments, small business loans, and circulating money for liquidity. So what happened in the Great Recession of 2008, when the credit markets froze and the banks were going under, was not something that the Fed forgot. Shiller also has an idea of the Fed theory. This theory says that the Fed is using its unlimited money printing machine to single-handedly prop up the market, and that the Fed is in itself an important role, but in reality, the Fed's magic over the real economy is limited. But its statements clearly move markets, and it has lots of power as a storyteller. And then we have the fear of missing out. He thinks the fear of missing out is a prominent thing among investors. He says time and time again, the stock market has tanked and then rebounded, and investors have been conditioned to put their money in when things look bad. And then we have Tina. No, it's not that kind of Tina. T-I-N-A. Which means there is no alternative theory, also known as Tina. And his interpretation says that with interest rates so low, stocks are the only money-making game in town. And related to the Tina theory is a theory known as secular stagnation. Basically, the economy has slowed, resulting in fewer good investment opportunities, and meanwhile, people and institutions have a crap full of savings and money, nowhere to put it. So it explains why interest rates have been so low, and it might explain why stock prices have been so high. Billionaire investor Leon Cooperman, he's CEO and chairman of Omega Advisors, a New York-based investment advisory firm who manages over $3.3 billion in assets under his watch, the majority of that consisting of his personal wealth. On Monday said that the emergence of individual investors eagerly scooping up stocks that have been rocked amid the coronavirus-induced downturn will ultimately not end well for those individual investors. Cooperman referred to a Barron's article that noted that free trading apps like Robinhood, the popular online trading platform, has added more than 3 million accounts this year, and now has over 13 million accounts, with participants of a median age of 31. The Robinhood markets are going to end in tears, said Cooperman during an NBC show, The Halftime Report. A number of recent reports attribute the market's rally since its March 23rd low and its subsequent choppy trading to an era of zero-commission discount brokerage trades and platforms like Robinhood that cater to younger investors. On a sad note, recently, Solimar Capital analyst Bill Brewster delivered a message to followers in a really heartbreaking Twitter feed. His cousin-in-law was interested in investing. He opened a Robinhood account, and he seemed to be enjoying the markets. As many of us do or have done, he got interested in options. He believed he had no margin on those options, so he began buying and selling options. Now fast forward that to sometime this past week, and his account showed him owing over $700,000. How does a 20-year-old with no income get access to that kind of leverage or exposure? He said the emotional stress from the exposure caused him to take his own life. Alex's story serves as a reminder that trading stocks can have devastating real-life consequences. This has perhaps never been more true than when it comes to using borrowed cash to leverage positions in a stock market where the Dow Jones Industrial Average can be down almost 2,000 points in one session and then rebound nearly 500 points in the next. And finally, we have the efficient market theory. The efficient market theory paints the stock market as a super machine for information processing, where knowledge about the happenings of the world are aggregated by savant investors who rationally buy and sell stocks based upon the best information about their future performance. The theory basically says stock prices are always right. Well, Shiller is really critical of the efficient market theory. He is a behavioral economist who believes we're not perfectly irrational beings, and that the theory assumes that. He also believes that we're prone to all sorts of quirks and biases, and we're influenced by narratives that may or may not have a good relationship to reality. Instead of a rational assessment of the pandemic and its future effects on the economy, Shiller sees potentially wishful thinking bias in people's minds. He says if a politician tells you it's time to reopen and the epidemiologist is skeptical, well, maybe the politician will win out because he is a better storyteller. And even though some people get very lucky in the market, the majority will lose money, while the really smart few will run with their profits and you will be holding the bag. So in the long term, it's always best to invest for the long term. Maybe in index funds that follow the market, and which in the long term have proven that the market gyrations from week to week and year to year will be forgotten. You can time the market. So invest consistently, buy and hold, and you have a much better shot at increasing your wealth. So I hope this is helpful, and please don't forget to smash the like button for the YouTube algorithm and subscribe. And thanks.